Welcome to C2 Biz Growth Iron Sharpens Iron podcast, where CEOs and entrepreneurs share how they are overcoming business growth and sustainability challenges.
Hello, I am your host, John Hale III, and Ivan Barratt is our guest. And Ivan, we are honored to have you join us today. Ivan is the founder and CEO of BAM Companies. They own multifamily properties. They're a fund manager and a syndicator as well, and specializing primarily in large apartment communities in the Midwest. And BAM Companies is a 7-time Inc. 5000 firm. It has won numerous business awards as well. So Ivan, welcome. Glad to have you with us today.
Good to be here, John. Good to be with you today.
Yeah, thank you. So we want to first start with, Ivan, just how you're showing up today. We know that as the CEO and founder of BAM, that you have acquired over 9,000 apartment units, raised over $500 million to get your firm started and moving. Could you tell us about early career or childhood? What really inspired you to be able to start the company and to move forward like you are now?
Yeah. Thank you, John. Early on, my father was an attorney practicing law, but he owned a lot of rental properties. And in 1996, Rich Dad, Poor Dad came out. I was graduating high school, and he gave me that book. And that, combined with helping him on his rental properties, my brother and I were basically his landscaping arm early on, waking up all summer long to mow lawns and pull weeds and rake leaves in the fall. It came to me that why would anyone want a real job, just own a lot of rental property and watch the checks come in. Turns out it's a real job, and it's a hard one, but it's a rewarding one. Always had the entrepreneurship bug early on. Really, the dream was to have a big company one day, and then decided to focus in on real estate. And for a host of reasons, focused in on what we would call commercial multifamily. So some people might think of it as residential because there are folks living in our apartment homes. But at a bigger scale, it's a commercial asset class. And that became my chosen food group, as we say in real estate, out of the 4 food groups: industrial, retail, office, and multifamily. That became my food group of choice, my asset class to focus in on, and started it in my spare bedroom with hopes and dreams, and grew it from there. I was everything, one-man show in the beginning, to where what you see today. We've transacted about $1.7 billion of assets. That $500 million of equity that we've raised since we started doing this for our investors in 2015 is spread across 1,600 plus investors that write a check for anywhere from $200,000 or $100,000 in some cases, all the way up to tens of millions of dollars and everything in between. And we manage their real estate as their partner, which is basically at its root is what real estate syndication and fund management is. It's a partnership between me and individuals that give me the latitude to make decisions on a day-to-day basis, operate the deal, buy the business, fix the business, and then eventually sell the business and return capital plus more to our investors. It just so happens that business we're buying and fixing is typically now a few thousand apartments at a time in one of our funds. It's very much an operating business, and we grew it from the ground up. And we had this crazy idea early on to have a property management company with good culture. And in an industry where, the Glassdoor rating for most property management companies is sub 3, we are, I think a 4.8 last time I checked, which is more meaningful and more rewarding to me than all the Inc. 5000 awards and all the growth accolades. It's the culture we've created on the execution side of the business, which is simple to me. If we treat people well and we grow that culture, then they do a better job executing on behalf of our investors. And the returns that we generate are a byproduct of our efforts on that front.
That is a mouthful. And And just thank you for sharing all that. No, it's fantastic. So as you were talking, several questions came to mind. But if I think about it broadly, there's two sets of customers, if you will, maybe three that you're serving. So one are the investors that would have access from a wealth creation, wealth management to be able to actually invest in the commercial real estate sector. And in this case, or as you put it, the food group would be multifamily uh, housing. And then the other stakeholder would be the people that actually work for you. And you're right, most times we think about the property management of a company, of a real estate firm. To me, that can be the hidden sauce from a revenue standpoint. We can talk about that later. And then the third group would be just the renters and the communities that you're in terms of my understanding that you do mostly buying existing properties and you enhance them with amenities. And so those customers or those clients benefit from having a great place to live, raise their family. Is that a good way of understanding kind of the three different stakeholders that you serve?
Absolutely. You named all our stakeholders right there.
Okay.
In order, we're a little bit different than a lot of companies. Now, of course, foremost is our investors, our partners that come alongside us and expect us to execute at a high level. And so far, we've got a great track record of returns to the investors, and we want to maintain that over time. The better I do there, the easier it is to raise capital for the next adventure. And then next to that is our employees. So a lot of property management companies they've got the resident experience in their core values. We do not. In multifamily, it's a transient business. People stay maybe an average of 2 years. They're typically turning over 35, 40% of your apartments annually. And of course, we want those folks to have a great experience. We work hard to get good ratings at the property level for those residents. But our employees are here much longer. Just recently, we celebrated some 10-year anniversaries. 2 of those celebrations were maintenance folks that have been with us for now over a decade. And that was really special to me because early on, I thought, hey, I know this is going to shock you, John, but you treat maintenance people really well,
Right.
and get them interested in working for us rather than constantly chasing folks, then they'll take care of us. Take care of them, they'll take care of us. And that's starting to really prove out, and we're just so proud of it. And so that family, those folks that work for us, that make us look good on behalf of the whole squad here to our investors, are really 1A and 1B with our investors. And then beyond that, yes, you do have the resident. Like I said, we want the resident. We strive to have the resident have a great experience. That being said, at the end of the day, it is a contractual obligation we have. They rent from us. If the rent's late, they got to pay a late fee. That's part of it. So that's sort of the order of priority.
Thank you for sharing that, Ivan. And it really sounds like for the other CEOs that may be listening that are trying to grow and scale their business, really a focus on the culture of the organization makes a large difference just in the performance, particularly in an industry. There's a high customer touch and feel to where they live in terms of being happy or satisfied with the service.
I couldn't agree more. Culture is everything around here. There was a point many years ago where I could just work harder and fix things myself, but we've gone way past that as a 200 plus person organization. And I'm very fortunate, very blessed really to have several folks on leadership that early on took that proverbial baton and ran with it, and just simply look to find an answer to a question: how do we create a management company where people like their jobs? And core values that hold dear to that, and a focus on it, the attention it deserves, creates this beautiful machine of humans that execute well at a high level.
Right. And so then looking back a couple of years, as you were moving out, I guess you said, from that spare bedroom and you start moving out to grow your company, how did you put together your team? And it sounds like now with over 200 folks, it's well-oiled machine, if you will. But in the early days, how did you identify the talent? How did you put together that team? And how did you get them to mesh well?
That's a great question. Early on, it was a lot different, especially from 2010 to 2015 when we were a third-party manager to other investors. Before we did our own large deals and eventually our own funds, we serviced other investors who had single family and small multifamily and small apartments here in the Midwest. Most of those were out-of-state investors that owned assets, and we were their property manager. So that helped me start to build an infrastructure of people and processes to one day scale it. Early on, the hiring and firing was much more of a revolving door, and it was very hard to get good people. And it's, I think, a process that most entrepreneurs have to go through if they're a founder of a and hope to be a large company. Is that early on, you're going to have a lot of times where you're basically hit in the mouth, knocked on the floor, right? And you've got to get back up. Then, starting in 2015, I was really able to have enough scale to get some key employees. That's also when my business partner came in. So we operate on or for a long time on the EOS sort of philosophy, where I'm the visionary, he's the integrator or the operator. To those that don't understand the EOS or traction, so it's my job to be out there fundraising, thinking about vision, where we're taking the company, and he's a much better operator, keeping the trains running on time, managing people, managing teams, executing on my ideas. And we tend to stay out of each other's lanes as much as possible. And so once we got that a little figured out, we were able to start attracting more key people. Getting them to mesh early on was going to the EOS playbook and forming those early leadership teams, getting everybody on the same page. And one of the first big exercises we did was coming up with our core values. And instead of being aspirational with those core values, we focused on who we were at the time and what it meant to be an employee at BAM. First and foremost, I'll start with this one. We have a fun, quirky spirit around here. If you're straight-laced or tightly wound, you're probably not going to make it at BAM. Don't want to take ourselves too seriously. The job is hard enough, so we tend to kind of be a little silly at times. We have fun. Our GIF game on Slack is pretty strong. And next, we work hard, we play hard, we win, and so we focus a lot on hard work, but also on having a lot of fun. Quarterly events, annual outings where the whole company gets together across 7 states now and thousands of apartments. We're pretty spread out, so finding ways to bring everybody together to learn, to have fun, to grow is very important to us. Which leads me to the next one, which is when people grow, BAM grows. And so we really focus a lot on internal growth, leadership tracks, self-improvement training, lots of opportunities for those folks that are meant to be here and want career growth to have those opportunities to do it with us. Not everybody's going to stay forever. People come, they go. Our hope is that we leave them better than we found them. And then the last one, we're a loyal, loving family. We're still really focused on being a family. Sure, there's different rules to be in the family versus some other families, but we're loyal and we're loving. People that are loyal to us, we take care of them. One of my favorite anecdotes to that is a maintenance guy that had been with us for only a few months, but had really been crushing it on the community that he was working at. Unfortunately, had a motorcycle accident and did not check the disability box. Well, loyal, loving family means that we're going to be loyal to him, and we took care of him, even though he didn't have access to disability. But we helped find a way to take care of him until he was able to come back to work. And there's numerous stories like that. So this is a place where if you work hard, you play hard, and you come to win, we will be loyal to you when the waters get choppy.
Right. Thank you for sharing that in terms of the whole transition from BAM to Bamily, that it really sees that your growth and your partner's growth personally and as CEOs and leaders, your company grew right along with that. As you were growing, giving yourself time and challenges to grow personally, the company just has grown right along with you all. And it seems like with the team, it's just grown even further.
Yeah. So, and as a leader, I still focus a lot on my own self-improvement, right? But also what's really important as I started to grow is figuring out what I'm great at and what I'm not great at and shouldn't be doing. In fact, what I suck at, right?
Right.
And finding and allowing people to take charge of those areas that I shouldn't be meddling in, even when they screw up, even when little bad things happen, to let those bad things happen. That's part of how people grow. Even sometimes or oftentimes it might cost us money, right? It might have an expense attached to it, but that person's learning a valuable lesson.
Gotcha. No, thank you for sharing that. And so you mentioned the people aspect of it. I want to come back just to the capital aspect for other CEOs looking to grow and scale their business. Thank you for thoroughly covering that aspect of it. And on the capital, as you were moving from your spare bedroom and you moved to grow the company, how did you find fundraising? I guess in two-part question is, one is, before you had the fund, maybe doing more third-party work, how did you guys capitalize the company at that point?
Well, I was a bootstrapped founder, so what that means for the audience is I did not raise any angel investment or any early rounds. I did not raise outside capital. I was able to bootstrap the company slowly, steadily, but surely, by providing a service to investors and by dealing with their residents and their toilets and all the things that go with property management. And so I used that revenue. Luckily, at the time, my wife had a pretty good job and was still employed and doing very well. And so I was able to reinvest most of my capital back into the business. So we've been able to grow that without taking on any outside equity. And then from time to time, we've certainly used operating lines, credit lines, to grow the company or to make investments. And that's great when I can do that, because that cost of capital is a lot cheaper than the equity capital out there for business. And then on the real estate side, John, it's very capital intensive. Deals we're doing now are 40, 50, 60, 70 million. Ease of example here, if it's $100 million deal, it's going to loan you maybe 60, 65 million. And so you've still got to get another 35, 40 million of equity from investors. That was a full-time job very early on. I was the one-man show there while my partner was running the management and the acquisition of assets. I would be breakfast, some days, many days, 2 lunch meetings in a row at the same restaurant, afternoon coffee, calls, just constantly on the hunt for capital for our investments. At that time, it was still one apartment deal at a time, until 2019, where we started raising capital for funds to start buying more bigger assets. Real estate is incredibly capital intensive, so I am always on the hunt, always out there fundraising. What's really great about having a partner that's in many ways opposite of me and has a lot of strengths, is that he's put together a fantastic team, including himself, that are really good on the execution side and the acquisition of real estate. He's better at it than I could ever hope to be. As much as I like looking at real estate deals and love going out and touring apartment projects that might be for sale, that team is better at underwriting those deals and then executing on the management than I could ever hope to be. And so as a team, though, we are greater than the sum of the parts, because I can spend my time with now another team of professionals that assist me on the investment management side of the house, or the capital management side of the house, where we service our current investors and are out there fundraising for more through referrals and a lot online now. But what's changed in the marketplace John, it used to be that you and I would have to be at the same country club to do a real estate deal together. And then when the Jobs Act allowed for sponsors like me to generally solicit what we call in the space to accredited investors, I was able to go out there digitally and attract investment from all across the country, almost every state now, and beyond, starting to take foreign capital as well.
No, that's fantastic in terms of how the legislative environment did open up. Congress had passed that to you being a point to being able to actually take advantage of that.
It's a
and it-
huge trend.
yeah,
Huge
no,
trend,
it's particularly for private companies, particularly those private companies who may not want to go public, but that are growing, such as your own, kind of trying to just get the ball rolling in terms of we've got a product or service. I think the beauty of what you're doing, at least kind of what I'm identifying as a secret sauce, correct me if I'm wrong, is particularly from a commercial real estate standpoint, you started off focusing on property management, that being serving as a property management arm for other companies. And property management is really kind of where you execute that portion of the P&L, getting that cost down while being able to maximize service and the quality of the product to the renters, but also doing it at the lowest possible cost and getting real efficient there. Not only you get a great reputation of product, but you can drop those savings right to the bottom line and reinvest back in your company.
You are absolutely correct, and I love that the way you put it. Business owners get this more than some of our other investors that might be in medical or some other space. We've got a lot of business owners that invest alongside us, and they understand that the way we create value is on the operation side. Is the dollars and nickels and dimes that we're able to pick up at various points of that P&L for the property. And in my space, every dollar that I add to the bottom line annually is worth about $20 of value when it's time to sell. So it's not always easy to find, but it's pretty simple. We look for assets that are mismanaged, undermanaged. They've got out-of-state ownership. They've hired a mediocre third-party manager. That's one of my favorite targets. And we can come in there, and it's really like buying a company, like a private equity play in a lot of ways. But when I come in and buy the business, it's pencils down. Thank you for your service. My team will take it from here. We come in with our strategy, our tech stack, our HVAC trained maintenance professionals. We're not calling outside contractors every time the heat or the cooling breaks down. We're able to fix that in house. And so we drop a lot of dollars to the bottom line across several aspects of the profit and the expense.
Right. No. Thank you for sharing that. And a lot of other CEOs can really learn as they're growing their business is there's always a trend, at least to think, or sometimes CEOs are really encouraged to just outsource different aspects of their business and focus on their core. And what you're saying here, particularly in your industry and what you've taken advantage of is, hey, we are vertically focused. We have this integration. And so that way we can control the cost, but just if not more importantly, we can control the quality of the work we're doing.
Absolutely. Yeah. 1A and 1B, cost and quality. Absolutely.
Right. So let me ask you this. It seems like from an investor standpoint, traditionally, if I as an investor wanted to get access to, correct me if I'm wrong, Class A real estate, Class A multifamily, these large communities that have some amenities and then they're located in good areas in terms of, they've got a quality school district, et cetera. And then that's where schools are big in terms of the valuation, and I want to be there for a variety of reasons. That can be, so heretofore before the Jobs Act, it seemed like I had to be a large investor, perhaps a pension fund, large family office to be able to invest in these properties, in these projects. And so when the check sizes you mentioned earlier, obviously to most people that are listing $100,000 or $200,000 to be able to participate is still a lot of money. But you're able to attract more type of investors than the traditional pension funds, et cetera. Heretofore, you had to have a, multi-seven-figure check to be able to get involved in some of these projects.
Yeah, you're very close. You're very close
Okay.
there. And you summed up most of it, John. The other way is maybe you knew somebody at the country club that was putting together a deal that might make sense for your portfolio. But you're right; those are typically smaller scale. Now with the legislation in place, we're able to go after those 60, $80 million truly investment grade institutional assets. And many times the competition for us is a large pension fund or other sort of large player in the space. For you as an individual investor, your access to those types of deals, were typically via like a Blackstone. And the only issue with that is when you're invested with a large company, public company like that, there's a lot more fees and costs between you and the product.
Mhm.
Now, thanks to the internet, you and I can have a relationship. You can meet BAM, do your own due diligence on BAM, decide if we're a fit for your portfolio, and invest directly with us. Now, of course, there's still some fees involved because we have to pay for this great team we have here, right? But there's a lot less cost in the stack compared to a large public behemoth like a Blackstone. And so, whereas, for example, Blackstone B-REIT, great product, they execute well, but you as the investor can expect a 9 to maybe an 11% return. And that still comes with all the risk of owning real estate, right? It's a cyclical business. With me, we've again transacted about $1.7 billion. We've sold 13 communities so far, and our average return on those communities to our investors is a 35% IRR. Quite a big
Impressive.
premium to go direct.
Right. No, thank you for sharing that. Because one of my next questions was going to be just the competitors. If you look at, you mentioned Blackstone, you mentioned REITs, et cetera, so it sounds like the advantage here is the return you can drive of going direct to you and not having the overhead of the large publicly traded company in terms of fees and costs.
Yeah, now
Performance.
sometimes they can push me out of the way, right? And I can lose a deal to them because I can't I have to have my line in the sand on what I pay for an asset. But if they're that big, that big cruise ship out there on the ocean, that big oil tanker, it takes a lot for them to change direction. BAM's like a small speedboat, so we can be a lot more nimble and go places where they haven't gone yet. I can get ahead of them, and in my business, it's fairly simple to see where the puck is headed.
Right.
And so I can get ahead of them into markets that are emerging. And if I can find an undermanaged asset in an emerging market where I know they've got great schools and rent growth and a lot of growth coming in the future, I can generate higher returns
Okay.
by doing those three things: adding that value through our operations, finding that great marketplace, but also one that's starting to bend upwards.
In terms of looking at the company, Ivan, doing some research on the company and yourself and just the track record, one of the lessons that some CEOs, other listeners may gather from this is you've had a really intentional and focused strategy, meaning a discipline to the sector, if you will, or the food group you mentioned, in commercial real estate, large.
Yeah.
I would describe it as Class A multifamily. If I'm using the wrong term, please let me know if that's the wrong one to use.
Well, you got it. You nailed it. Yeah.
Okay. And then it seems like to be a geographic focus on the Midwest. Oftentimes, having lived in Washington, D.C. for a while, I spent a lot of time there and in the Midwest. Folks on other coasts will sometimes view the Midwest as kind of flyover country, if you will. I'm sure you've heard that term. What is it about?
I love it. I love it.
Yeah,
keep calling it that. Keep telling your friends.
So what is it about your
country.
discipline and focus on?
There's nothing to see here, John.
There's nothing? Keep going. Hey, stay in Florida, New York. Stay out in Portland.
Nothing to see here. Nothing going on.
Gotcha. So what is it about the Midwest, other than understanding you being from here in the Midwest, but what about the Midwest you're looking to grow and scale your business?
Yeah.
What's the hidden, I would call it, hidden value that you see here in the Midwest? That seems to be a very big focus of your strategy, is not only just the food group, but as the geographic focus.
Absolutely. And it's becoming more known. So we'll see what holds in the future, but I am blessed to be born in the great state of Indiana. What I saw happening here early on was a successful decoupling from the Rust Belt. world-class suburbs, A-plus schools, diverse employment, technology, finance, insurance, healthcare, biotech, military, defense, the list goes on. And that flyover country moniker. And so what that has the setup for is finding undervalued assets. And as a value investor, when I can find assets that are undervalued, I've got a much higher chance of success. So what we've seen in the Midwest is this repeated. Pittsburgh, another great example. People still think it's an old steel town. They've got high ranks in technology and some in education and some other facets. And while I might not invest in the downtown urban core of Pittsburgh, it's got world-class suburbs. Same thing for Kansas City. And these places have decades of steady eddy population growth. Like I said, great schools and diverse employment. And so that's a setup for a great place to own housing, right? There's a lot of people that want to live there. Despite what they think in LA, New York, San Francisco, DC, Miami, a lot of people live here.
No, gotcha. And so how do you define the Midwest? You mentioned Pittsburgh, Kansas City, Indiana. How far south would you go? And
that's a great debate. So now we're in we've got a couple deals in Rogers, Arkansas, which I would call the South, but it's got the Midwest characteristics that we like. Fastest growing small city in the country right now. Walmart transformed that town. That's their headquarters. They have just begun moving from a regional office makeup in their company to shuttering all those regional offices, requiring all those folks to move to Bentonville. And that's going to create about 14,000 jobs just from Walmart alone at their new phenomenal corporate campus, let alone all the ancillary vendors that are required to have an office there, to be in Walmart or on Walmart shelves rather. And then the way they've taken care of that town and invested in that town and the arts, it's a mountain biking mecca. The list goes on. It is a really cool place. And so we're buying in one of their high-end suburbs called Rogers. My apartments are near a Top Golf. They're near the country club with the $5 million homes that are owned by Walmart executives, in the best schools around. And so while I might not call that the Midwest, or I might lose that debate that it's the Midwest, it's got those characteristics that attract me as a buyer.
Gotcha. No. Thank you for sharing that discipline strategy. Another question that came to mind is, can you give us an example or story or two of a bold move, calculated risk that you took, and maybe one that paid off handsomely that you thought would, and maybe one that perhaps didn't generate the returns you thought, and just share what you learned from that?
Yeah. I'll give you the bad one first.
Okay.
One of the earliest deals I did on my own, I had one partner. It was a 35-unit asset. It was not Class A. I thought it was Class C, John, but it turned out it was Class D. And so this was before syndication. This is just me and a partner. Everything that could have gone wrong went wrong on that deal. Couldn't raise the rents. Could barely collect the rents. A lot of problems there. Evictions, bed bugs, drugs. We had an overdose in an apartment, more bed bugs, sewer line collapse. I was on the news when a snowstorm collapsed one of the carports, and the gal that refused to pay carport rent but parked her car under it anyway called the news because her car got destroyed by a carport with too much snow on it. And again, everything that could have gone wrong on that deal went wrong. So many formative lessons learned. Like thinking I could improve it out of the cash flow from rents. That's a big no-no in my space. You got to have the capital for CapEx up front. Don't think you're going to do it out of cash flow. Sold that deal 5 or 6 years later for a 9% IRR. That investor's still with me today. He's invested in, maybe 15 deals so far. So he stuck with me. We did eke out a decent return that was still kind of with the market at 9% annualized, but don't want to go through that again for sure. And then on the other side, and we're doing this again right now, but thanks to having all these individual investors, we've been able to pounce on opportunities when the institutions put their pencils down and aren't buying. The first time was COVID, when we locked down. In the beginning, everybody thought it was GFC or 2008 2.0, and no one was buying real estate. Institutions weren't getting on airplanes to fly to Indianapolis and tour deals. Everybody basically just stopped. And my partner and I were able to scrape together about 45 million of equity, bought about 150 million of real estate, and several of those big returns that we've produced for our investors came from that first fund, because of the time in the cycle we were able to buy when no one else could. I think we're about maybe the same age, so I go all the way back to Trading Places, Eddie Murphy, Dan Aykroyd. They're standing on the floor of the commodities exchange. Everybody's going sell, 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 and they're like, buy, right? And that was us. We were able to do it, and we absolutely killed it. And then that has happened again with interest rates going up at an unprecedented rate of change. That's created another buyer's market for different reasons, obviously, but it's created another down cycle for multifamily. So while I'm not selling many assets right now, and that may change here soon as the market stabilizes, through 2022, 23, and 24, we were in buy mode, foot on the gas, buying as much real estate as we could. And while that story is still being written, I think there's a decent chance we'll look pretty smart buying when we did. And by the way, at the same time, I was buying big companies like Blackstone, KKR, and Brookfield, invested 20 plus billion in multifamily. The big guys were able to buy, and a few of us little guys who could still scrape together equity with our loyal investors were able to buy.
Right. Shifting gears a little bit, Ivan, just a general question, just about our economy, about the housing industry. Why do you think we have a housing shortage? Why is there this excess of demand over supply? We think about that from a residential single family home, but also,
Sure.
Do you see that in your industry, Class A multifamily? Is there a shortage?
Well, we'll talk nationally here, because locally you've got areas of the country that are certainly short, and other areas of the country where they've got excess supply, and you're seeing rents fall. Austin being a great example. They overbuilt in that market tremendously, and they've seen, depending on who you follow, double-digit rent decline, which is good for the renter, not so good for the investor. At a national level, really since the GFC, since 2008, we haven't been building enough single-family and multifamily homes. It started to ramp up again, and we had a record amount of supply coming on the market. But that, because of the rise in interest rates, liquidity dries up, access to debt financing, construction financing dries up, and far fewer developers and builders are able to execute their projects. And so you've seen a lot of supply come up in 23 and 24 at record amounts, but then it's fallen just as fast off a cliff in light of the drying up of liquidity. And so we're still estimated to be short millions of homes in this country. It's anybody's guess how long it'll take for that to sort of even out, but it's been, almost 15 years now since this has started.
Right. Since the 08 crisis, 07, 08?
Yeah, and it takes a lot of time. You've got to assemble land, right? You've got to get land. Continues to get more expensive even here in the Midwest. You've got to get it approved by local municipalities. That's typically an uphill battle in most jurisdictions. And then if you get through all that, you've got to put shovels in the dirt and start building. And so there's a lot of lag effect in feasibility to fruition.
Right. And so it sounds, hence part of your strategy has been, it sounds like, to not develop your own, or maybe develop a couple of projects, but primarily buy existing large apartment communities that you can enhance through property management, et cetera, to create your returns, as opposed to taking that development risk?
Yeah, so we've got 3 strategies now. Our main flagship strategy is the acquisition of those assets that we've been talking about. Find something that's mismanaged, undermanaged, acquiring it, enhancing operations, and selling it for hopefully a big return. We also capitalize some local development partners that have great deals, a great pipeline, but they lost, they don't have enough capital for the amount of pipeline they have. So we've done a handful of what we call joint ventures, where we've capitalized the development. Our investors have been asking for it for a long time. And so now they get access to some of these development deals, which can carry really high returns in a short amount of time. And it's been a great new product to offer our investors, and a great strategy by pairing with developer builders that already have that core competency in that aspect. That's a whole different business than what we do. And so we'd rather partner with someone who's really good at it. And the third strategy, which is gaining a ton of traction, is our income strategy. We've got about 135 million in that vehicle so far, and that delivers monthly returns to investors that are more cash flow dependent, or they're at a stage in their career, maybe they're semi-retired. We've got a lot of business owners that have had liquidity events, and now they're just looking to earn steady monthly income on the wealth that they've created, with a margin of safety and as low risk as possible. And so they're in what we call the preferred equity, or the debt position on institutional grade assets. So let's say you're no longer looking for growth, John. You've made the money you want to make, and now you just want to have fun in retirement, get monthly passive income, and maybe travel the world, or support your philanthropy, or your whatever it is you're passionate about, right? And so you now can participate as the bank in our investments by investing in a portion of the debt that's attached to that bank, so you're paid first.
That's a great strategy.
Yeah, we've done it now, going on right about 6 years now. We've been working that strategy, and every month, like clockwork, people are getting an annualized return of anywhere from 8 to 11%, depending on the specific vehicle that they're in. So that $1 million investor is making about $110,000 a year, divided by 12. They're getting distributed monthly, and when they're ready to stop getting those monthly payments, they get their capital back.
That's fantastic. Thanks for sharing that. Just as you've grown the company over time, it creates more opportunities to attract investors, more, I would say, different products for the investor that's at a different stage of their life cycle.
You got it. You nailed it.
We got it. Go ahead. When you were creating your first fund, can you speak to the strategy or challenges you had, and kind of how you can maybe overcame the doubt, even though you're working with some investors? How did you start getting them and maybe some new investors to actually invest in a fund that you would manage for the first, that first fund, which is always the hardest?
Great question. Yeah, that first fund was incredibly difficult. It's very hard in this business, or any business rather, to go from deal by deal, whether you're buying companies or buying real estate, to a fund. And gosh, I remember being on the phone with practically every single investor in one-on-one calls to convert them from being a single asset investor, saying, hey, I only invest deal by deal. And so I had to literally call everybody, explain why I was doing it, why it was good for me, and the advantages for me, but also the numerous advantages for the investor. And it took a lot of hand-holding initially. And then, today you still get investors that want to be more deal by deal. They want to underwrite where every nail is hammered. And then you've got investors that rather would bet on the jockey, which in this case is BAM, and their ability to execute. And so the goal is to have a certain level of trust with the investor, that betting on the jockey betting that when I say it's a deal, versus looking at every deal. So you're really going from, hey, Mr. Investor, instead of underwriting this asset, I want you to underwrite me, underwrite my company, underwrite my track record, underwrite our management team, our management style, and make an investment decision based on what you see there versus looking at every individual deal and trying to figure out if I'm doing a good deal or not.
Gotcha.
Track record really helps with that.
Yes.
It's a little bit easier to go from a great track record of returns to funds versus just coming out of the gate with a fund. I've seen a lot of folks try and fail doing that.
Right. So it seems like one of the lessons learned here would be to develop that track record. Here in real estate, you're buying businesses, whatever assets you're looking to buy or funds you're managing, is to spend time, uh, maybe feel like a grind, but being able to leverage that over time after having that positive performance. And that, in essence, you could bundle those together and say, hey, here's the portfolio you would have today if you would have invested with me 2 years ago. Look at the projects that we've executed in the transaction.
That's exactly right. And as an entrepreneur founder, there are seasons where we have to grind.
Yes. Amen to that. Hey, Ivan, I want you to share with us, what do you think your superpower is, or that special talent that you have that has enabled you to become the leader you are today? And how did you find that? How did you discover that power?
Yeah, so I discovered early on, working at the mall at an athletic apparel and shoe store, that I had a knack for sales. And it drove some of those other guys there crazy. I'd show up early on Jordan Day, and I'd sell out the Jordans before anybody knew what happened. I'd be running back and forth. I'd have some stashed up front. What size you need? You know, um, and that was my first real exposure to working on commission, and really had a sales job ever since then. Lots of sales training early in my career. Really learned the art and science of sales and influence, and realized that was my talent, and pairing that with a big vision. And so I've been able to do a lot of fundraising and bring a lot of capital on board, but also influencing others. Selling the dream of what I was looking to create here at BAM to those early leaders that really were taking a risk for a small, small business that one day had hopes of being big. And so that's really what I spend a lot of my time focusing on, is that influence and that sales.
Gotcha. I also wanted to ask, what is next for you in BAM? If you look at from an equity raise, $500 million, which is impressive, purchased 9,000 apartment units, but with 1.75 billion in transactions. What do you want to be when you grow up, and what does BAM want to be when BAM grows up?
I love that. Well, we're figuring out right now, how do we 10x BAM? If BAM's worth about 100 million of enterprise value, right? How do we become a $1 billion company? So asking that question of our team today, what would a $1 billion company do, right? If there's a question or a decision that needs to be made, what would a $1 billion company do? The biggest governor on how fast we get there is my report card in faith, marriage, kids, physical fitness, fun, and spending a lot of time in those categories. So we're really focused on doing this one thing really, really well. We've got these 3 adjacent strategies, but we're not looking to really expand out beyond the asset class. We like the fact that no matter what happens to the economy, people need a place to live. So housing is a really good place to be if you can execute well. And so, yeah, we've got bigger dreams ahead, but there's certainly a governor on how long it takes to get there, based on those other factors that I have to get high grades in to actually be successful. It doesn't matter how many zeros I got in the bank if my marriage goes to crap and my kids don't like me. All the money in the world doesn't really mean much.
Amen. No, that is an important lesson. Maybe the crown jewel you shared so much today of just scaling and growing your business, and just that balance and that focus, and just having those priorities. Because we all know so many CEOs, entrepreneurs, he or she, that have done tremendously well, But what's the other aspect of their life? What is their life really like when you draw back that curtain? What are they going home to?
Well, now I'm giving you an amen. I know. Before we got on the air, I know your kids are in their 20s. Mine are 13, 11, and 9. They still like me. They still want to hang out with me a lot. So,
Dad is
and,
still cool. That's important.
yeah, and Mom still likes me too. So doing my best to keep that going.
Great. As you've grown your company, do you have a board of directors, and why not? And is that something you view as a possible resource, tool, strategy to help you grow your company to that enterprise value
Yeah, I love
of $1
that
billion?
question. I've often thought at somewhere down the road we'll have like a formalized board. But currently, I lean a lot on some individuals in my life that help mentor me through YPO and another group, Tiger 21. I get a lot of access to CEOs. So I spend time sitting at the feet of CEOs that are much farther up the mountain than I am, and just asking them, "Hey, how'd you get up there?" And trying to get wisdom. Wisdom is just so important. So I'm out there on the road seeking wisdom, and then I've got groups that I'm pretty tight with. My Tiger 21 group is my most favorite forum. A lot of great men in that group that certainly from time to time would fill that board of directors role when I'm facing an issue.
Mhm. No, great. No, thank you for sharing that, because I think it's important to our listeners, and particularly other CEOs that are growing and scaling their company, that you have to keep, have mentors, have those resources around you, kind of where you can have a closed door conversation with folks about what's
Absolutely.
going
And
on,
then
what's happening. Because being a leader um, sometimes can be a isolating type experience.
I couldn't agree more. I do feel blessed to have a great partner. He's my Charlie Munger, the yin to my yang, the peanut butter jelly sandwich. So it's a little less lonely because I can bounce a lot off him. I did want to add though that outside executive coaching, consultants, and then in my own personal life, anywhere I'm looking to improve spiritually, financially, business, fitness, marriage, parenting, um, all the above. I've got an outside coach helping me make improvements in those areas where I am seeking improvement.
Mhm. No, thank you for really sharing that point. Particularly, I think uh, making a generalization, more the men I talk to are less open to those conversations, or feeling the need that they need those resources, or that they need a coach, or need to have someone playing that role in their lives. More the women CEOs I talk to seem to be more open to that than
Yeah,
some of the men.
we as
Yeah,
men, we've got it's a drug once you get hooked on it. Like a guy was asking me the other, guy was asking me the other day. He's like, "How's your marriage?" Right? And I said, "Listen, there's seasons, right? And it was a particularly tough season. We lost her dad, we lost my brother, and he was a little worried for me. I said, "Hey, man, I'm stacking my bench with strong Christian men, who can pour into me and help keep me on the right path."
right, right. No, thank you for sharing that, because a lot of men, I don't know if it's just some machismo,
We tend
or
to isolate.
right, we tend to isolate, or I just did it myself, or like you said earlier, in your company, at some point you grew through the point of no one can fix it like me and as quick as me. And I joke sometimes with CEOs, you keep doing that, and by the time you're 40, 45, you have a heart attack.
Well, like that's great advice, John. It gets you so far, but then you get to this
Yeah,
point where what got you here won't get you to where you want to go next, and you've got to evolve, you got to change again, and you got to bring new tools, flex new muscles,
right.
and yeah, isolation or just thinking I'm gonna work harder. At this point, if I tried that, other things would start breaking.
Right. And one final question, Ivan, I want to thank you for your time with us today is, what's a final message you wanted to share for other CEOs who are listening, who are growing and scaling their business? You served so much. Any other final lessons or thoughts you'd like to share with them?
I'm just going to double down on what I said on coaching and peer groups. They have been rocket fuel to my personal and professional development. Seek wisdom, seek groups. One thing that was definitely uncomfortable early on, but is now it's another thing I'm addicted to, is getting into a room where I am the little fish, right? I could rest on my success and, oh, look at me and look how great I've done. but I need to get in that next room where I'm the little fish. It's uncomfortable, but those bigger fish in there aren't there to eat me. They're there to teach me. And I would stress that at any level of entrepreneurship or being a CEO is to seek out those coaches. I spend over 6 figures a year in coaching. Seek out those peer groups where you've got some people that are come around you that are dealing with the same issues you're dealing with, and maybe a few that are higher up the mountain that you can converse with.
Well, thank you. That's fabulous. Thank you for sharing that. And thank you for being vulnerable that way, because a lot of men aren't. But that is
absolutely, man.
Incredible.
This is one of my favorite podcasts. I've done a lot, John, but I'm enjoying this. I'm sorry we got to.
Thank you. No, I thought that was fabulous. Just from my experience in banking, corporate reorganization, restructuring, I find so fascinating the people behind scaling and growing businesses. And I've always felt, being a finance professional by trade, everyone's focused on the EBITDA or the valuation. And I'm always looking at what's the amoeba or the tissue in between the bones. What are the people? What are the culture that really, I think I've coined the saying, I think I'm the original to it. I haven't found it out there yet. It says, as the eyes are the window to the soul, the financial statements are a window to the soul of a company. And I think those numbers tell a great result you guys have and are having. So kudos to you and your partner and team, but it's everything else, just the people behind it. And that, to me, that's the exciting stuff. This has been fascinating.
It's a beautiful, beautiful machine of humans.
Well, hey, thanks for everything. Thanks for coming on, and we'll just keep in touch.
Yeah, likewise. I really enjoyed this one. Had a lot of fun, and hopefully we can blow it up on the socials. And we'll talk to you soon.
Thank you for listening to the C2 Biz Growth Iron Sharpens Iron podcast. And check us out on social media, share, and subscribe.